Good evening. Please come to this wonderful IAS 36. This is called Impairment of Assets. Okay, what is the meaning of impairment? Reduction in value. Something whose value has gone down. If you don't study, your career will be impaired. So, what will happen? Okay, you understood. What is the purpose of issuing this standard? Already we have a standard IAS 16 property plant equipment where the company can revalue an asset downward. But what is the need? Revaluation model is an option. Revaluation model is an option. So even if the value of the asset has gone down, a company following cost model will continue to show the asset at cost minus depreciation. So what was the problem that was happening? And this is nothing wrong because your standard allows you to follow cost model. So the book value of the asset may appear 500 crore, but its recoverable amount is 200 crore. That is the maximum I can recover from this asset is 200 crore. But the asset is appearing in the books at 500 crore. So the problem is that people who look at your statement of financial position, they may take this figure for decision making because they don't know about this figure. You are an outsider, you are a banker. You don't know what is the value of this asset. So you may look at the SOFP 500 crore. Okay, let us give 50% loan against the asset. So you will give a loan of 250 crore. And you may think that, oh, I am safe. What will happen? This company may default. Still, I have a collateral or security of 500 crore. That is how you may think. Just for example. And suppose the company defaults. So banker will recover this asset. Now the banker wants to sell this asset to recover their loan. And they could realize only rupees 200 crore. So therefore they would suffer a loss of 50 crore. This is just an oversimplified example to tell you that how a wrong value in the financial statement can cause loss to the stakeholders. Even equity investors, when they do the valuation of the company, so what is the formula they use for value of share? One of the formulae we use is assets minus liabilities divided by number of shares. This basic formula, at least this gives you a rough idea that what is this share worth. And the asset figure you will take from the financial statement. So of course, if this figure is overstated compared to recoverable amount, you have overvalued your share, you have put more money, and tomorrow assume company goes into liquidation. You will not be able to realize what you have invested. So the standard says we should not show an asset at an amount more than, complete the line. We should not show an asset more than its recoverable amount. Fill in the blanks question, 1 mark. Asset should not be shown in the balance sheet above its dash amount, recoverable amount. So what is recoverable amount? We will discuss. But you have understood the significance of the standard. The standard will be very useful for the people who take long-term decisions about investment in a company, either as a shareholder, creditor, or lenders, bankers. With the change in technology, with the change in economic environment, the value of the asset also changes very fast, and therefore the value of the asset may go down drastically So therefore we need to impair the asset in the books of the account so that carrying amount should not exceed the recoverable amount. Now let us see the scope of the standard. Those areas which are already covered by other standards will not be covered by this standard. For example, inventory. Does IAS 2 cover impairment of inventory? Cost or net realizable value, whichever is lower. So what you are doing, when the moment the NRV goes below the cost, it means the value of the inventory has gone down, impaired, reduce the cost. Then deferred tax asset, we will discuss in IAS 12, asset arising from employee benefit, IAS 19, financial asset, IFRS 9, biological asset, IAS 41, and non-current asset classified as held for sale is IFRS 5. Okay. Does it apply to financial asset? Generally, the financial asset covered by this IFRS 9 will not be covered. But financial asset like investment in subsidiary as defined in IFRS 10 or associate as defined in IAS 28 or joint venture as defined in IFRS 11, the investment in these three group entities, if they are impaired, they will be covered by this standard, because IFRS 9 has exempted these three instruments. To understand the standard better, first understand certain terms. Those which you already know, will go through it quickly. For example, carrying amount. Carrying amount means cost minus depreciation minus accumulated impairment loss. Oh, question number 1 has come so fast. ASF Limited purchased a machine for 5 lakh, accumulated depreciation 1,50,000. Calculate the carrying amount. How much? Write down. 5 lakh minus 1,50,000, 3,50,000. So when you are going to compare the recoverable amount, you are going to compare with which number? 3,50,000, not with 5 lakh. 3,50,000 is the relevant number for further discussion. What is a cash generating unit? Cash generating unit. First, we need to know why we need to understand cash generating unit. The standard says you have to compute recoverable amount. Okay. Recoverable amount means higher of the two. Assets fair value less cost to sell and value in use. Value in use is the present value of future cash flow. Now this is my asset. Suppose this computer is my asset, okay? And I want to find out the value in use of this computer, means present value of future cash flow. Does this computer generate independent cash flow? Do I give it on rent? No. Then I use it, but along with other assets. So I can't calculate the value in use of individual asset. So then what I'll do? I will take a group of asset which generates cash flow independently. And this group of asset we will call cash generating unit. We will calculate value in use of cash generating unit if I can't calculate the value in use of individual asset. Right? So what is the definition? A CGU, so we will call it CGU, is the smallest identifiable group of asset. Start with the individual asset, 1. If 1 does not generate independent cash flow, then take smallest group of asset that generates cash inflow, which are largely independent of cash inflow from other assets or groups of assets. right? But then this sometimes may require judgment. So we'll discuss 3-4 cases for understanding the concept of CGU. We have to check whether it generates cash inflow, which is largely independent of cash flow of other assets or group of assets. Okay. So read this example and tell me what is the CGU in this example on the screen. A mining enterprise owns a private railway to support its mining activities. The private railway could be sold only for scrap value, and the private railway does not generate cash inflow from continuing use that are largely independent of the cash inflow from the other assets of the mine. Okay. So what will be the CGU for this? This is suppose mine and this is a railway. Okay. Railway. Question is, what is the CGU? The whole mine. Because the problem itself says railway does not generate cash flow from continuing use. So in case if I want to check impairment of railway, it can't be done. Why? Because its value in use cannot be calculated. Okay. So the whole mine will be treated as CGU. In case if there is any indication of impairment, compute the recoverable amount of the mine, and if there is an impairment, allocate it to the value in use. Okay, one more question. This is printed in your book. A hotel has several restaurants, rooms, conference hall, health club, and other facilities. So this is the hotel. Restaurants, rooms, conference hall, other facilities. Since each of the facilities, now in the exam the question can be in a case study problem, because in case study problem you have to first identify what is the cash generating unit. So can I say that restaurant is a cash generating unit, conference hall is a cash generating unit, or health club is a cash generating unit, or this entire hotel is a cash generating unit? Because in this case it is difficult to prove that this restaurant generate independent cash flow. Since each of these facilities are not capable of generating revenue independently, the entire hotel and not the individual facility would be treated as a CGU. A person who comes to stay in the hotel, this is hotel room, will use the services of restaurant, or a person who comes to attend the conference may use the services of restaurant. A person who comes to attend restaurant may go to some other facility also. So therefore they are saying that these cash flows are not independent. They are dependent on each other. Okay, now you come to this one more case study. A huge multiplex has a bowling alley. What is that? Ball. That huge ball they throw, and I don't like that game personally. First of all, it is very expensive. Secondly, it looks very stupid to me. You throw a ball on something, and sometimes you also fall along with that. And next thing, they make me open my shoes and put their shoes in that place where you have to throw that ball. Okay. So there are some, what do you call them? Bottles kind of thing. And then you throw a ball. It may go from this side, sometimes it may hit also. and it may have theaters also. So you'll find there are theaters 1, 2, 3, 4. Then there are hotels on the top 2, 3, 4 floors. There is a shopping mall on the ground floor, first floor. All these are there in one huge multiplex. The question is, what is the CGU? This bowling alley, can it be called as a CGU? These theaters, can they be called as CGU? Okay. Shopping mall, can it be called as CGU? If you can separate the cash flow independently, then the answer is yes. But if they are all dependent on each other, then the answer is no. So in this case, it is very difficult to say that cash flow generated by this bowling alley is independent of the cash flow generated by the theaters. So people will come to theater, in case if they have to wait for an hour, they will go to this other section. So whole hotel or whole multiplex will become a CGU now. Okay, now this question is also interesting. It is not there in your book, probably on the screen. A bus company provides service under contract with a municipality that requires minimum service on each of the 5 routes. So this happens in many cities. The government will give you a license to operate private bus, but then there are conditions. You have to run this bus in these 5 routes. Okay, compulsorily. The reason is that maybe this route may not be very attractive, very profitable. So the bus service will only focus on those locations where you have more customer. Asset devoted to each route and the cash flow from each route can be identified separately. So there are 2 buses devoted for each route. So asset identified. Every day I can calculate how much cash flow route A generates, B generates, C, D, E. Then this interesting question was asked, that what is the CGU for this bus company? Each individual bus route or all 5 routes taken together will be treated as CGU? So the institute has given the answer. This whole 5 fleet of buses taken together will be treated as CGU. Why? Because the contract is such that you can't only run 4 routes. Even if one of the routes is operating at a loss, you have to run all 5 routes to continue with that license to operate bus. So they are all actually interlinked with each other. Hence, all 5 routes will be treated as one CGU. And now we'll come to corporate assets. What is the concept of corporate asset? So first you look at this example, head office building. Head office building does not generate cash flow. It is not involved in any revenue generating activity. It is not supplying goods and service. But then what is the function of head office? It gives services to other cash generating units. It gives services to other cash generating unit. So they provide administration services to other CGU. So whenever you have to test the head office building or corporate asset for impairment, you can do so only after allocating it to those CGUs who have benefited from this corporate asset. So now you see the meaning. Calculation will do later. Assets other than goodwill that contribute to the future cash flow of both the CGU under review and other cash generating units. Why they have written it should be other than goodwill? For goodwill we have a different treatment, right? For goodwill we have different treatment, And therefore, while discussing corporate asset, goodwill will not be discussed here. Goodwill will be treated as a separate heading, and that contribute to the future cash flow of both the CGU under review and the other CGUs. The meaning of this line is that suppose you think a particular CGU has been impaired. In case if there are any corporate assets, check, can we allocate on some reasonable basis corporate asset to CGU? If yes, first allocate, get total carrying amount including the allocated portion of CGU, okay? And this total carrying amount will be compared with recoverable amount. This total carrying amount will be compared with recoverable amount, and then we will decide the impairment loss. So that is the concept of corporate asset. Now we'll see the meaning of cost of disposal. Why this term cost of disposal is discussed here? In order to calculate recoverable amount, we have to calculate fair value less cost to dispose or cost of disposal. Is it right? Cost of disposal means incremental cost that you are going to incur at the time of disposal of an asset or a CGU. Example, right? Dismantling cost. What is the meaning of dismantling? Removal. Then you will add any transport cost to take the asset to the market, any legal fees, any brokerage. These are called legal cost. These are called disposal cost. What will not be included in that cost of disposal? Any finance cost will not be included, any tax expense will not be included. Then depreciable amount means cost minus residual value. Depreciation means systematic allocation of depreciable amount over the useful life. And now you tick mark this important definition, which is called fair value less cost to sell. So first you find out the fair value of the asset, then find out the cost to sell, and that is called fair value less cost to sell. Where do we require it? Recoverable amount, correct. So fair value means the amount obtainable from sale of an asset or CGU in an arm's length transaction between knowledgeable willing parties minus the cost of disposal. So basically net amount you will realize. In case if you dispose the asset today, to keep you awake, solve question number 2 there. ASF Limited has a machine which is fixed to the ground. The cost of unfastening the machine is rupees 2,500. The fair value of the machine is rupees 40,000. Calculate the fair value less cost of disposal. Answer. Alright, 37,500 there. 40,000 minus 2,500. Solve one more question number 3 on your own. X operates in a leased premises. It owns a bottling plant which is situated in a single factory unit. Bottling plants are sold periodically as complete assets. So this is about CGU. Previous example was on single asset. Professional valuers have estimated that plant might be sold for rupees 1 lakh. X would need to dismantle the asset and ship it to the buyer. Dismantling and shipping cost will be 5,000. Specialist packaging would cost a further rupees 4,000 and legal fees rupees 1,500. Now in this example, tell me what is the fair value less cost of disposal. 89,000? 89,500. Oh, wonderful. Write down. Selling price 1 lakh. Dismantling and shipping cost 5,000 minus packaging minus 4,000. Legal fees 1,500. Therefore, fair value less cost of disposal, positive number 89,500. This will be used for calculating the recoverable amount. Now come to value in use, printed somewhere below. Value in use means the present value of future cash flow expected to be derived from an asset or a CGU, right? Like one example we will discuss. Suppose there is a asset and you have to calculate future cash flow. Management estimates is that for next 3 years, 10 lakh. Again after 3 years, 8 lakh for each of the next 3 years. Discount rate is 15%. Find out the value in use. So solve. I will give you the format and then you will solve. Write down year, cash flow, discounting factor at 15%, present value. You can write instead of 1, 2, 3, 4, 5, 6, 1-3, 4-6 if you are comfortable in that way. And then you apply the factor. Take calculator. Compute the present value factor. Then take the total of the last column. It comes to approximately 34.84 crores, 34.84 lakhs. Is it there? Yes. Right? So this is how you will calculate the value in use. In the classroom, it looks so easy. But many companies don't like this standard. The reason, you can't estimate your profit for 1 year. When you have to file your income tax, advance tax on 15 June, you don't know how much will be your total profit for the year. And here the institute is asking, the standard is asking you to estimate for next 5 years, 6 years. So this is really a difficult task, a huge scope of manipulation here. In case if you don't want to show impairment loss, what you will do? Increase the value in use. Assume you have more cash flow. And then you can protect your company from impairment loss. Now, one more term tick mark above. What is recoverable amount? Recoverable amount means higher of the two. Recoverable amount of an asset or CGU is higher of the two. It's fair value less cost to sell and its value in use. You are an accountant. Normally you are conservative. Normally you say higher, lower of the two. Everywhere in the different standard, lower of the two, lower of the three. But this time higher. Why? If you are a businessman, you have a machine. The question is, what will you do with that machine? If you sell it and suppose you realize 50,000 rupees after considering cost to sell, but if you use it and the present value of future cash flow from this asset is say 60,000. So what is your decision? The decision will be use. So we'll take this value. But suppose my example is this is 40,000. Your decision will be to sell. So I'll take this value. So based on this logic, they have decided the definition of recoverable amount. And now finally, what is impairment loss? Impairment loss means CA minus RA. Okay. If CA is greater than RA. This is the formula of impairment loss we will use. But you must write a condition here. CA must be greater than RA. If CA is less than RA, your answer will become negative. That is not impairment gain. There is no concept of impairment gain. There is only impairment loss and reversal of impairment loss. So this is the formula printed in your book also. Carrying amount, which is equal to cost minus accumulated depreciation and amortization and impairment. And recoverable amount, which is higher of the two, value in use, fair value less cost to sell, and the difference is impairment loss. Solve this question. Is it there? Or is it there at the end? The carrying value of a building in the books of Sun Limited as on 31st March 20X1 is 300 lakh. As on that date, the value in use is 250 lakh. And fair value less cost to sell is 238 lakh. Calculate the recoverable amount. Or you solve on the screen only. Nothing great about this question. First tell me what is the carrying amount? 300. Recoverable amount is higher of the two. 250, 238. So what is recoverable amount? 250. Answer is over. And in case if they ask you that what is the impairment loss, then what will be your answer? Impairment loss will be 300 minus 250, that is 50. Okay. So don't worry about this question. This was oversimplified. Now, when is an asset said to be impaired? An asset is impaired when its carrying amount is more than recoverable amount. Or recoverable amount is less than carrying amount. Is it right? Does company check for impairment for each and every asset every year? Yes. No. Suppose I have these 100 assets. Do I check for each asset for impairment every year? Suppose I have 10 CGUs. Do I check for impairment of all 10 CGUs every year? No reasonable. There is a answer in the standard. You will test for impairment when there are indications. When there are indications that the asset is impaired. But in 3 situations, you have to test it for impairment every year, even if there are no indication. Which are these 3 conditions in your note? Point number A, an intangible asset with indefinite useful life. This is given in Ind AS 38. Check it for impairment. Don't amortize it. Check it for impairment. Second, an intangible asset not yet available for use. So you have an intangible asset, but you are not able to use it. Say, for example, a license granted by the government, but then you are not able to use it to generate the future economic benefit. There are some hindrances. Let's say Supreme Court has put a ban on this, stay on this. That means there is uncertainty about the future economic benefit. So intangible asset not yet available for use. Check for impairment every year. And goodwill acquired in business combination is not amortized but checked for impairment every year. So these are the three items. That can be a small theory question also, that management does not want to check for impairment. Then your answer will be you should check for impairment when there are impairment indicators. However, in following three cases, annual impairment testing is mandatory, and then these are the three assets. For other assets or other CGUs, you need to have an indication of impairment. Indication will come from where? External sources. Internal sources. What is external source? From outside the organization, from the market. Okay. An internal source means something within the organization tells you that the asset is impaired. So example of external sources. Market value of the asset has declined significantly. Then what it should be after passage of time and normal use. So pay attention here. Now how do you get indication here? Let us take the example of this computer only. In the books it is appearing at 1 lakh. And now when we see the newspaper ad, it says this computer available for 70,000 rupees. Okay. Then I am wondering, oh, my book value is 1 lakh. But same computer is now available at 70,000. So what is this? Not impairment. Indication of impairment. That does not mean I have to impair it necessarily, because I have to compute recoverable amount. Which is higher of the two? Fair value less cost to sell, value in use. What has gone down is fair value less cost to sell, but possibly the value in use have not changed, and that is still higher than 1 lakh. So therefore do not assume that change in or fall in market price is impairment. It is indication of impairment. Second is, again you have to keep your eyes and ears open when you move around the move in the market. This is adverse impact, or there will be an adverse impact in the technological, market, economic or legal environment in which the entity operates. So you have invested in technology based product. Let's say you have a mobile phone company and you manufacture mobile phone. Huge investment you have made in a certain kind of mobile phone, okay, which has all the latest features. But then what happened? 1 year down the line, Apple has come out with another version, and your technology, which seemed very advanced last year, a year back, looks outdated. So what will happen to the demand for your mobile phone? Decrease or remain same? Decrease. So what is the impact on value and use? Value in use will decline, because value in use is the present value of future cash flow. So when the new and better technology, advanced version is available in the market, demand for your mobile phone will decline. Okay. Value in use will go down. Market conditions may change. Market condition. So the customer taste, fashion may change, and the kind of product that you are selling, they may not demand it anymore. Suppose a company manufactures glass bottles. Okay, what they manufacture? Glass bottles, and this is sold to soft drink companies, and then soft drink companies use it for selling it to the customer. But then over a period of time, now the customers, they don't want to have soft drink in glass bottles. What do you want? Soft drink in glass bottle, or that can, or that plastic bottle, Tetra Pak? Correct. Now this company have invested in machines which are designed to manufacture glass bottles only. All those molds etc. will serve this purpose. So they started getting less order from the soft drink company. The soft drink company says my customer wants Tetra Pak, plastic bottle, cans, so I cannot place order with you. Bottle, you can't do anything with these machines now. So fair value will go down, value in use will go down. So that is market. Economic condition, recession will be there, demand has gone down. Legal environment, very important. So when you are doing audit of a company also, or when you are in a business, keep checking the law which might affect the company adversely. Like for example, car, diesel car company. What government says? We will not allow you to now sell diesel car in certain states altogether. Value in use will fall. Or you manufacture cigarettes, wines, etc. Ban. Next, plastic. Correct. I was thinking of that only. Plastic is banned and your company manufactures plastics. Value in use will go down. Right. Third is interest rate may increase. So how does increase in interest rate affect impairment calculation? Maybe this market interest rate is linked to the discount rate that you use for value in use calculation. There is an inverse relationship between discount rate and present value. Higher the discount rate, lower the present value. This you have learnt in your financial management subject. So increase in discount rate means present value may fall. Carrying amount of the net asset is more than market capitalization. Now this is also an indication of impairment. Many times students find it difficult to understand this line. This is your statement of financial position. Asset side 150, liability side 100. So what is your equity? 50. Net asset is 50. As per the SOFP, the worth of your share is 50. Then we find market capitalization. How it is calculated? Number of equity shares into MPS. Suppose there are 1 crore share, market price is 40. So the market capitalization is 40 crore. This question they have asked also sometimes in the exam, that will this situation give rise to impairment testing? Yes. Is the answer yes? Why? Market value of your net asset is 40 crore. Can I say that? Book value of your net asset 50 crore, but the market thinks, the investor in the market thinks, no, these net assets are worth 40 crores only. So if the company is liquidated today, you will get 40 crore only. This is what the market thinks, whereas your book value is 50 crore. Which means there is an indication that the asset might be overstated. This is an indication of impairment. Then internal sources, obsolescence. You find that some asset has become obsolete. They are not being used now. They are just lying in the company but of no use. Indication of impairment. Physical damage to the asset. This projector has fallen. It has broken. will the value remain same or it will go down? Simple example, a machine gets damaged and then your internal MIS reports. Every company prepares budget, okay, a good company, and then it prepares actual also. And then your MIS is saying this month we have budgeted for 20,000 unit sales, actual sale 5,000. Oh. Capacity utilization was expected to be 80%, only 20%. Return on investment was expected 15%, only 5%, 10%. These are just simple example for understanding. So when you have important financial parameters, all are showing adverse outcome, then this is an indication of impairment. It means your value in use may fall. And therefore you have to test the asset for impairment. So now you solve this question. Just you have to tell me whether there is any indication of impairment. Carrying amount in the balance sheet net of accumulated depreciation is 340 lakh. Assets are 2-year-old. Present market price is 300 lakh. The company charges 10% depreciation assuming 10-year useful life. So to cut the long story short, carrying amount is 340 lakh. Market price is 300 lakh. Only you have to see answer whether there is indication of impairment. Yes. First point was written also. Market price is less than the book value. Second, estimated life of the asset has been reduced to 5 years instead of remaining 8 years because of technological changes. Is it an indication of impairment? Yes. Because you were supposed to receive cash flow for 8 years. Now the technology has changed, so your asset will become redundant after 5 years only. So you have a loss of 3 years of cash flow that you could have generated. Market interest rate has increased from 14 to 15%. Yes, present value will fall. Student usually ask me this question, book value to market capitalization is 0.80. Is it an indicator of impairment? Yes. This is actually, you change the number, it is 1.20 actually. Make a correction, 1.20. No, now you tell me, this is the right question. Book value upon market capitalization is 1.2 upon 1. Means market capitalization is 1 crore, book value is 1.2 crore. Then only the ratio will be 1.2. Now my question is, if it is 1.2, what is the answer? Indication of impairment, because your book value is higher than market capitalization. But if it is 0.80, then the answer is no. So first, second, third answer is yes. Fourth answer for 0.80, no. But for 1.20, the answer is yes. Just write a ratio, whatever they will give you in the exam. They may give reverse also. Market capitalization to book value is 0.8. Then the answer is yes. It is indication of impairment. Market capitalization to book value is 1.20. Then it is not an indication of impairment. Otherwise you write like this and see what is the situation. Now we'll come to impairment loss calculation. Just follow this simple step. compute the carrying amount, compute the recoverable amount. If recoverable amount is lower, provide impairment loss. To compute recoverable amount, take higher of the two. Fair value less cost to sell, value in use. Now to make your life simpler, the standard says if any of the two component is higher than the carrying amount, no need to compute the other component, because we have to take higher of the two. Write this example. Carrying amount of the asset 3,40,000, 3,40,000. Fair value less cost to sell 3,65,000. This is first example. Suppose I did this calculation first. I found fair value less cost to sell first. And then I found that, oh, this is higher than 3,40,000. Do I need to spend my time, energy, resource in finding the value in use? Not required. Okay, right here, not required. And then suppose case 2, you did this calculation first, 3,80,000 value in use. Do you need to waste your time, energy, resource, go to the market, ask for quotation, calculate cost of sale, etc.? No. The moment the first calculation exceeds the carrying amount, the other calculation is not required. Okay. Dear student, come to para 9. Para 9 is what are the care you will take in calculating fair value less cost to sell. First is find out the fair value in a binding sale agreement in an arm's length transaction. Find out the fair value from price in a binding sale agreement in an arm's length transaction. This is the first priority. That means suppose there is a contract to sell the asset. Arm's length transactions means the buyer and the seller are free to buy and sell. The buyer is not forced to buy, the seller is not forced to sell. It is totally a commercial transaction, no related party, no extra commercial consideration is involved. That is arm's length price. Okay. Like suppose you go to the shop below and say, I want to buy this pen. He says 40 rupees. So from one hand you give 40 rupees and from the other hand you receive the pen. That is arm's length. And then if suppose that is not there, take the current bid price of the asset in an active market. That means the latest price at which this asset is traded in active market. What is active market? Large number of buyers and sellers, homogeneous product, prices are available. If that is also not available, then take recent market transaction price of similar asset within the same industry. If current bid prices are unavailable. So first you, if possible, take same. If same is not possible, then take similar. If that is also not there, then the amount based on the best information available to the entity. So the best information. So this is how you will arrive at fair value. First, binding sale agreement price, BSA, same item traded in the market, similar asset, best information, and cost of disposal, as we discussed earlier, should be direct consequences of the disposal of the asset, and it will be deducted from the fair value to arrive at cost of disposal. This is about fair value. Next we will discuss cash flows briefly, because from exam point of view these cash flows are given to you ready-made. Only what you have to do, present value. But then soon you will become a chartered, a qualified gentleman, qualified lady, okay? And then your boss will say, now you apply this standard IAS 36. This is a client which has given 40,000 rupees for impairment testing. Go and do the impairment testing for this client. So then you will have to find out the future cash flow which the asset would generate. So what are the guidelines they have given? One is the assumptions used in projection shall be based on management's best estimate of the economic condition that is expected to prevail during the life of the asset. It's a pure estimation based calculation. More importance should be given to external evidence. Now, how do you start this calculation? You ask the management, please show me your budget. Please show me your budget. Do they prepare budget? Yes, of course, the big entities, they prepare budgets. They keep the budgets of next 3, 4, up to 5 years also ready, because they have a vision, they have a plan. Accordingly, they have to raise funds, buy assets, human resource management, sales planning, everything has to be done on the basis of budget. So that budget is my starting point. So cash flow should be based on the recent financial budget approved by the management or like data, with adjustment to be inconsistent with the past actual outcomes. So this is my starting point. Take the budgets, but then you can't actually copy paste the budget in calculation of future cash flow. Management is usually highly optimistic. Okay, management is highly optimistic, so they will say our sales will grow at the rate of 20%. So they are taking 20% growth rate. Check their past performance. In the past, the growth rate in sale is somewhere around 5 to 6%. Then you ask them, if last 5 years your growth rate is 5 to 6%, how can you say it will be 20%? Check the industry growth rate. This is my first paragraph. External evidence. Industry growth rate for that product, let us say that is also growing at the rate of 5 to 6%. Oh, then you have to adjust these numbers. Then you have to adjust this number, because this is optimistic assumption. And then the standard says projection shall not be more than for 5 years. However, this assumption is rebutable. What is rebutable? You can take more than 5 years also, right? If you have got a license to operate for 10 years, then you can say I will take 10 years. Then future restructuring, 1 or 2 more points we will discuss. Future restructuring not yet committed. Future restructuring not yet committed and cash outflow to improve or enhance performance is not considered. Underline. Practically, when you do this impairment audit, these are the points management will raise, that they will say we are going to restructure this business, we are going to repair this asset, we are going to do something and this asset will generate more revenue in future. So what you will say? First do it. First do it. So future restructuring for which management has not yet committed, it's only a plan in the mind, then we are not going to consider that in calculation of our cash flow. Then financing cash flow and tax cash flows will not be considered. So while estimating cash flow, interest, income tax will not be considered. Last point there, if the asset generates cash flow in foreign currency, there is a question I am going to solve on this paragraph. They can ask you question from any paragraph. Keep in mind, in a case study, what they do, it looks like a case study, but actually there are many questions asking a simple question on each and every standard paragraph of standard, like this one. If the asset generates cash flow in foreign currency, the future cash flow will be projected in foreign currency. So step 1, estimate the future cash flow in foreign currency. Like a machine which is situated outside the country. Your project is outside India. And discount rate will be used, will also be the discount rate prevailing in the concerned economic environment. Is it right? So you will do it like this: year 1, 2, 3, 4. Cash flow in dollar. You will write cash flow in dollar. Present value factor. Which present value factor you will take? That is applicable for foreign project. Applicable for foreign currency, not for home currency. And then you will get present value of cash inflow. In which currency you will get this answer? Foreign currency. And now this you convert into home currency by applying spot rate. By applying spot rate. By applying, what is spot rate? Today's rate. Because this figure has already been converted into present value. So first you do every calculation in foreign currency, discount rate applicable to foreign investment, and then convert into present value, apply spot rate. The present value thus arrived is translated into functional currency at the spot rate. And then you have to apply the impairment testing. So some interesting situation can come. If I look at the foreign currency, the asset may not be impaired. But when I convert into home currency, functional currency, the asset might be impaired. In this process, it is possible that in terms of foreign currency, there may be impairment, but not in terms of functional currency. Because after you convert into functional currency, the value may go up because of exchange rate and is not impaired, vice versa. It may not be impaired in the foreign currency, but it might be impaired in the functional currency. So you have to check this figure, that is after converting into functional currency, compare it with your carrying amount, and then if there is an impairment, apply the impairment testing. Is it right? So now we will take a break.